Good evening. Welcome to session 5 of Moms on the Money Trail. My name is Bethany Blessing, and I am the Director of Public Engagement and Outreach for the Pennsylvania Insurance Department. Tonight, we'll be talking about insurance basics and how understanding insurance can greatly impact your financial well-being. Our agenda, we're going to cover auto, homeowners, renters insurance, health insurance basics, and life insurance tonight. So starting off with auto insurance. Did you know that 26% of young people would rather clean a toilet than try to understand insurance benefits? Trust me, I get it, not the most exciting topic, but financial literacy is about earning, saving, and protecting your money. That's what insurance is for. Did you know that at 55 miles per hour, sending or reading a text is like driving the length of a football field with your eyes closed? Did you know that 25% of distracted drivers involved in fatal crashes were young adults aged 20 to 29? So why should you care? Everyone talks about the physical risks of bad driving. You can die, you can kill someone, or more likely, you end up in a wheelchair for the rest of your life. But dumb driving decisions can be pretty devastating here in your pocket. As you'll see, financial pain of bad driving can be just as long-term. You can wreck your credit score, which can keep you from getting a job or qualifying for an apartment. So let's learn some basic terms of auto insurance. An auto insurance policy is a legal contract between you and your insurance company. A premium is what you pay the insurance company for covering your risk. The payment can be weekly, monthly, every 6 months, or even once a year. The idea is you pay a little now to avoid paying a lot later when something bad happens. Insurance spreads costs of accidents across multiple drivers, which makes the cost lower for all. A claim, this is a notification to the insurance company that you suffered a loss. A loss is the cost in dollars of covered property damage or injuries defined in your policy. Limits, this is the maximum amount of protection in a policy for a specific type of coverage. And deductibles, this is what you pay out of your pocket before insurance reimbursement kicks in. This applies only to 2 coverage types, comprehensive and collision. As a rule, the higher your deductibles, the lower premium. So what is covered? Most insurance policies include specific benefits to protect you from significant financial loss. These specific benefits are comprehensive. This pays for damage to your vehicle caused by something other than a crash or collision, such as fire, vandalism, theft, falling objects like a tree, hitting potholes, or objects flying at you, like a bird or a deer. This is usually required by the lender if you have a loan. Collision, this pays for damage to your car caused by hitting something, such as a wall or another vehicle. Again, this is also usually required by your lender if you have a loan. And bodily injuries, this pays for injuries that happen to others in an auto accident that is your fault. Medical payments or personal injury protection. This pays medical bills for you and your injured passenger, regardless of who was at fault. This is usually required by state law. Rules, limitations, and monetary thresholds for filing a claim do vary by state. Property damage liability. This pays for damages to someone's property from an accident in which you were at fault. Uninsured motorists. This pays for injuries, not property damage, to you and your passengers from an accident caused by a motorist who does not have insurance. Finally, underinsured motorists. This pays for injuries, not property damage, to you and your passengers from an accident by a motorist without enough insurance to pay your claim. So who is covered? Auto insurance is attached to the vehicle. If the car is covered, insurance protects any of three roles likely affected by an accident or incident. So these three roles are the driver, which is the operator of the insured auto or any licensed person who has permission to drive. Passenger, anyone in the car with the driver of a covered auto who suffers a loss in an accident or incident that is your fault. And a pedestrian. This counts for anyone outside the covered auto who suffers a loss in an accident that is your fault. So there are several ways to buy insurance. Making the decision based on your knowledge and comfort level with the process. Once you decide what types and how much auto insurance coverage you need, you can request a quote, which is a statement detailing the premium you will pay for the specific coverage you request, through an insurance agent, which is a local professional paid by an insurance company to sell policies, or direct, which is purchasing from the insurance company without the help of an agent, or by phone or online. Now we are going to move over to homeowners insurance. A few more did you knows. The most common renter's insurance claim is fire. Only about 52% of homeowners said they prepared an inventory of their possessions to help document the things they own. If your laptop is stolen, shop, or your car, you can file a claim on your homeowner's or renter's policy. And you may need to buy additional insurance for property like jewelry, furs, and coins. So a homeowner's insurance policy is a legal contract between you and the insurance company. You agree to pay a premium, and it protects you against financial loss if there is damage to your home, your possessions, and liability in case someone gets hurt on your property. A homeowner's insurance policies usually contain a package of coverages that offer protection from a peril. Types of coverage are dwelling, other structures, personal property, loss of use, personal liability, and medical payments to others. Policies, again, it's what you pay the insurance company for covering your risk, and the cost in dollars of property damage or injuries covered in your policy is losses. So what's not covered? The coverage provided depends upon the type of policy you buy, but there are some common exclusions, which is a provision in the policy that explains what is not covered, found in most homeowners policies. Renter's insurance provides protection against damage to or theft of your personal property. It can also protect you if someone falls or gets hurt on the part of the premises you rent. Please make sure to note that your landlord's homeowner's insurance does not cover your belongings. So why buy renter's insurance? It is often overlooked, but for a very small premium, you can save a lot of money if something happens to your belongings. Depending on your policy, you can make a claim on your renter's insurance if you lose your bag while traveling. If your laptop is stolen from a coffee shop, your car, you can also file a claim on your policy. Most policies range from $20 to $30 a month. If you have a roommate, their policy does not necessarily cover you. You can begin a policy at any time, regardless of when you sign your lease. And most insurance companies will allow you to bundle your policy with another policy, like your car insurance, which would make it cheaper. Some rules to know. Insurance companies, they have 30 days to complete an investigation. If they can't complete that investigation within 30 days, they must tell you why. They have 10 days to acknowledge a claim and provide information for the next steps regarding that claim. Insurance companies also have a legal right to inspect the damage before any repairs occur, and they also can cancel your insurance policy if you do not pay your premium on time. If you have a question or concern, please make sure to contact our insurance department's consumer services team at 877-881-6388. If you have filed a claim on your home, please make sure to be wary of anyone who knocks at your door and offers to do your home repairs. If an individual presents himself as a public adjuster, ask for his or her licensing information. Do reference checks on contractors, and don't pay in full or sign that the work is complete until the work is actually complete. Heading on over to health insurance basics. So we are going to navigate health insurance. Having health insurance usually means you pay a premium every month, and in return, your health plan pays part of the bill when you need a service from a doctor or another provider to keep you healthy or treat a disease. Health insurance usually covers doctor's visits, prescription drugs, medical, surgical services. There are several different ways to get health insurance. Some people buy coverage on their own. Many people get coverage through their job or a family member's job. Others are covered through public programs such as Medicare or Medicaid. So going over individual market. So this would be buying health insurance on your own. When you or your family purchase health insurance and are not part of a group that gets health insurance coverage together, such as an employer, you're considered to have individual market coverage. Many people choose to buy individual market coverage through a health insurance marketplace, either healthcare.gov or their state's marketplace. Pennsylvania's state marketplace is Penny, and open enrollment runs from November 1st to January 15th every year. If you have lost your Medicaid coverage, visit penny.com to purchase quality health insurance options for low to no cost. Buying through a marketplace allows those who qualify to get premium tax credits to help with the cost of their coverage. And an insurance agent or broker can help you choose an individual market plan. Or your state may have health insurance navigators or other community-based assisters to help you. So while marketplaces only offer health insurance and dental coverage that meets certain requirements for benefits and coverage, other types of health insurance are also available to purchase on your own. These other types of insurance cover a more limited set of healthcare services and may choose not to cover you or charge you more if you have a pre-existing health condition. Short-term limited duration plans. This insurance covers some of the same types of services as comprehensive health insurance, but it's not required to offer a full set of essential health benefits. The plans typically cover a smaller share of the cost of services than comprehensive health insurance. That means you will pay less in premiums, but enrollees pay more when they need healthcare services. The plans may deny applicants or charge them more if they have pre-existing health conditions. Basic hospital expense coverage is insurance that covers a period of usually not less than 31 days of continuous in-hospital care and certain hospital outpatient services. Basic and medical surgical. This covers costs associated with a necessary surgery, including a certain number of days in hospital care. Hospital confinement. This pays a fixed amount for each day that you're in a hospital. Accident only. This will pay a lump sum when the enrollee experiences death, dismemberment, disability, or hospital and medical care caused by an accident. Specified disease coverage. This insurance covers diagnosis and treatment of a specifically named disease or diseases, such as cancer. Long-term care is usually pays for skilled, intermediate, and custodial care in a nursing home, as well as care in other settings, such as the home, adult daycare center, or assisted living facility. The policy usually pays a fixed amount per day while the person is receiving care. Other limited coverage, you may be able to, you may want to purchase insurance coverage covering only dental or vision or other specified care. And then employer-based coverage. Most non-elderly Americans get healthcare coverage through employment, either through their own job or family members. Employees and their families usually have a chance to sign up for coverage when starting a new job and once each year during an enrollment period. Then public coverage. So many people get health coverage through public programs like Medicare, Medicaid, and CHIP, which is the Children's Health Insurance Program. The federal Medicare program pays most of the medical expenses for people aged 65 or older, and for individuals under 65 receiving Social Security disability benefits. However, Medicare does not pay all expenses. As a result, some Medicare eligible individuals choose to buy a Medigap policy that helps pay for certain expenses, including deductibles that are not covered by Medicare. Medicaid and CHIP are administered by the states. So for Pennsylvania, that is administered through the Department of Human Services. So part of staying healthy is receiving essential routine and preventative services. The Affordable Care Act requires that all preventative healthcare services are made available to consumers at no cost. Even if you look healthy, you may not be getting the routine care you need to identify the unexpected, such as routine lab work used to prevent and diagnose, control chronic conditions such as diabetes, immunizations, to avoid illness such as measles or tetanus, and cancer screenings that can result in earlier detection and treatment, such as mammograms or prostate exam. Since life is full of surprises, insurance helps you prepare for the unexpected, such as an illness or a slip on ice. Even if you look healthy, you may be not getting the routine care you need to identify the unexpected, such as the preventative services, routine lab work, and the immunizations we just spoke about. Without health insurance, the cost of a broken arm is up to $7,500, and the cost of a hospital stay is around $10,000 a day without insurance. So, how do I know which plan to choose? You want to ask yourself 3 questions. Some insurance plans require you to see your primary care physician to obtain a referral in order to see a doctor for specialized service. If it is your responsibility to select a primary care provider or a PCP, an example of this model is an HMO, which is a health maintenance provider. Other models allow you to see certain doctors, providers, or specialists anytime. One example of this model is called the PPO, which is a preferred provider organization. Consider how often you visit the doctor. Do you see your PCP or specialist more? Your answer will help you decide if the HMO or PPO is best for you. So the 3 questions are going to be, do you need to see a specific doctor or other care provider? Do you need specific medical services or prescription drugs? And what mix of costs and fees work for you? The doctors and other caregivers a plan works with is called the plan provider network. You will pay less to see the providers that accept the health insurance plan you buy. This is called in-network. You will pay more to see providers that do not accept your health insurance plan. This is called out-of-network. Each insurance company publishes a list of the providers available in their plan on their website. That list is called a provider directory. If you like the doctor you have, you can ask your doctor which insurance plans they accept, or you can check these directories at any time to see if your doctor is in network. Some plans have more providers in their networks than others. Plans with more doctors tend to cost more, while plans with fewer doctors cost less. Think about how much you want to pay and how much you value the options for the providers you see when deciding whether a plan's network is right for you. If you need a special type of medical service to take a specific prescription drug, you can also check that the service or drug is covered under the insurance plan you are considering. You can see if a medical service is covered by reading the plan's summary of benefits and coverage, which is also called a CBC, which it's a short summary of a plan's benefit and coverage. Every plan should offer you a SBC when you're shopping, and you'll find a link to each plan's SBC on healthcare.gov or Penny when you're comparing plans. if you buy your insurance through the marketplace. If the SBC does not include information on a specific medical service, you can call the plan at the phone number listed at the top of the SBC to find out if the service is covered. A list of drugs covered under an insurance plan is called a formulary. Like the provider directory plan, formularies are available online. Plans often categorize drugs in terms of preferred or non-preferred. If a drug is preferred, it may mean that the fee paid when you fill the prescription is lower. So, what mix of costs and fees work for you? Your monthly insurance bill is called a premium. The other costs, copays, deductibles, and co-insurance and out-of-pocket limits are paid when you receive care. So just to keep track, your insurance plan keeps track of your costs. Each time you use your insurance company sends you a statement that tells you how you used your benefits. It is like a receipt. This is called an explanation of benefits or an EOB. An EOB is not a bill. An EOB will tell you how much the insurance plan will cover and how much you are responsible for or owe your provider. It will also tell you how far along you are in meeting your deductible and out-of-pocket limit. If you are asked to pay costs other than your monthly premium once you've reached your out-of-pocket limit, you should contact your insurance company. Remember the trade-off between monthly costs and the costs you pay when you receive care? That means that generally insurance plans with lower premiums have high deductibles and out-of-pocket limits and vice versa. So your premium is your sticker price. Your copay is the fee that you're charged when you receive service. And a deductible is the amount you pay first before your insurance company pays for care. In co-insurance, it's like a copay, but this is a percentage of the cost versus a fixed fee. And an out-of-pocket limit is the most you'll have to pay each year for covered services. So there are two graphics here, which I believe is very helpful, at least for me. Out-of-pocket costs include copays, co-insurance, and deductibles. They do not include premiums, non-covered services, or out-of-network charges. You can stop paying your copays, deductibles, and co-insurance once your out-of-pocket limit is met. All right, taking a break and moving on to life insurance. A little history. When was life insurance born? It was about 100 BC with the ancient Romans. They formed a burial club because they felt it important for all to be given a proper burial. And when did the sale of insurance start in the US? It was in 1759. It was in Philadelphia and New York City. They created the Corporation for Relief of Poor and Distressed Widows and Children by the Presbyterian ministers. So first we're going to talk about insurable interest. So in Pennsylvania, only an individual with insurable interest can obtain a life insurance policy on another. Insurable interest means, in this case, a person related by blood or law, an interest engendered by love and affection, and in the case of other persons, a lawful economic interest in having the life of the insured continue as distinguished from an interest, which would arise only by the death of the insured. All right, life insurance 101. So when you're thinking about life insurance, you should know there are two main types. They're called term and permanent. A term life insurance policy, if the insured dies during the term of the policy. Unlike term insurance, all permanent policies remain in place as long as the premium is paid. They also have a cash value component that increases over time, and it allows the owner to borrow against that cash value. There are four main types of permanent life insurance: whole life, universal life, variable universal life, index universal life. But this presentation, we're going to focus on the basic whole life insurance. So, whole life insurance. This offers a fixed premium for a certain duration or for the life of the policy, guaranteed annual cash value growth, and guaranteed death benefit. This does not provide investment flexibility, and once established, you are not allowed to change the policy coverage. Universal life insurance, this allows the policyholder to determine the amount and timing of premium payments within certain limits and to adjust coverage levels as needs change. There is no investment flexibility, and the cash value growth is based on current interest rate and current mortality rate, sometimes structured as term insurance. Variable universal life is a combination of variable and universal. This offers the most flexibility with the ability to vary premium payments, investments, and coverage amounts. This allows investment in a variety of market products chosen by the policyholder and may allow policyholders to make tax-free transfers among investments. This exposes the policyholder to a greater market risk than whole or universal life policies. An indexed universal this will allow the policyholder to determine the amount and timing of the premium payments, again, within certain limits, to adjust coverage levels as needs change. Includes guaranteed annual cash growth, but no investment flexibility, and investment gains based on indexed fund. So a few things affect life insurance premiums. The age you purchase your policy, the older you are, the more expensive the premiums. Your overall health, life insurance companies typically ask you about your medical history, request access to medical records, and even obtain blood and urine samples for testing. Pre-existing and or chronic health problems such as diabetes, heart disease, cancer, or sexually transmitted diseases may prevent you from getting life insurance or place you in high-risk pool at a greater cost. Another one is poor health habits, such as smoking and excessive drinking. Be aware that insurance companies may look back and consider these behaviors for the past 5 years. Engaging in dangerous hobbies, such as skydiving, skiing, or rock climbing. Your driving record. In terms of accidents, DWI, DUI citations, claims, and tickets, the better your driving record, the better rates you'll receive for your life insurance. And your geographic area. Life insurance companies have access to regional data that document mortality rates and life expectancy, and they use that data to calculate their rates they offer. So why would you consider life insurance? There are several reasons to purchase life insurance. You may need to replace income that would be lost with the death of a wage earner. You may want to make sure your dependents, such as your children, do not incur significant debt when you pass. Life insurance may allow them to keep assets versus selling them to pay outstanding bills or taxes. You should also consider the following factors when purchasing, such as medical expenses previous to death, burial costs, and estate taxes. Support while remaining family members try to secure employment, and continued monthly bills and expenses, daycare costs, college tuition, and retirement. So how much life insurance do you need? You'll need to ask yourself the following questions. How much of the family income do you provide? If you were to pass, how would your survivors, especially your children, get by? Does anyone else depend on you financially, such as your parents, your grandparents, brother, sister? Do you have children for whom you would like to set aside money for them to finish their education in the event of your death? How will your family pay final expenses and repay debts after my death? I know this isn't the happiest topic, but I'm glad you're all sticking with me. And do you have family members or organizations to whom I would like to leave money? Will there be estate taxes to pay after your death? And how will inflation affect future needs? Some tips for buying life insurance. Always, always, always make sure you feel confident in the insurance agent and company. Decide on how much you need, for how long, and what you can afford to pay. Learn what kind of policies will provide you what you need, and pick the one that is best for you. Do not sign an application until you review it carefully. So be sure their answers are complete and accurate. Do not leave blank information, as someone could fill the information in after you sign it. Do not buy life insurance unless you intend to stick with your plan. The policy may have surrender charges. You may buy a policy and make the check payable to the company, not the agent. So we have reached to the end of our presentation. I want to thank you so much for hanging in with me. I want to just very much emphasize that the insurance department, we are always here to help. So there are multiple ways that you can file a complaint. You can go to insurance.pa.gov under consumers, which is on the top right-hand corner. You'll click that and hit file a complaint, or you may always call our Consumer Services Bureau at 877-881-6388. If you have any questions or concerns, anything I didn't clarify in this presentation, or anything at all, please, please, please feel free to reach out to me. My email is betblessin@pa.gov, and my phone number is 717-783-0652. I want to thank you so much for all of your time tonight, and I hope you have a great evening.